Hi, everybody. Welcome. Episode number 44, Fintwit Panel. Today, we do this bi-weekly, and I'm joined by a sensational cast of panelists today. I'll have a very, very hard time topping this set of panelists this week going forward, so we're setting the bar very high, and I'm slightly nervous talking to these fine gentlemen because they're all really well entrenched in the junior mining space, and we'll get to them in a second. Just a quick reminder, please use hashtag AskUsUS for your questions here on Twitter. We will get to those at the end of our quick panel discussion here as well. And make sure you ask Joe, Florian, or Christian as well. We're all ready for questions. Follow us on YouTube, follow us on Twitter. We're going to upload this to Spotify afterwards as well. Now, it is my distinct honor to introduce three really well-known and really highly reputable executives, newsletter writers, and also investors from Switzerland onto this panel. I'm going to do a quick introduction real quick, and I'm sure you know most of them, and I hope I don't screw that part up because they're so well known. To my right, and we're going clockwise, is Joe Mazumdar. He's now the publisher of Exploration Insights. He joined Exploration Insights in 2015, taking over from Brent Cook, who is still a technical advisor to Exploration Insights. Joe is an exploration geologist by trade and has worked as a mining market analyst previously. So his career stops include Newmont, Phelps Dodge, Haywood, and Canaccord. So there's barely anybody better to talk about junior exploration and geology and economic geology than Joe. To his right is Florian Siegfried. He's the CEO and managing partner of SSI Asset Management. He runs the Precious Capital Global Mining and Metals Fund and currently has around 120 million Swiss francs or 165 million Canadian dollars under management, which is about, let's try to convert that into US dollars, about 130 million US dollars if I'm not mistaken. And then to my bottom right is Christian Mayo. I've known Christian for a while. He's the CEO of Equinox Gold, and Christian has been running Equinox since 2016, taking the company through various transactions, and now turned the company into a $3 billion market cap company, something I have to get used to. And I think Christian mentioned it. That's a completely new environment for him as well. So, gentlemen, thank you so much for joining me today. It's a real pleasure to have you on this panel.
Yeah, thanks, Guy.
Cool. Okay. I didn't want to talk about gold macroeconomics. We're not gold forecasters. None of us has a glass ball, but gold price reacted tremendously to the jobs report this morning. And Joe, I just want to quickly start with you. What do you make of the gold price drop today? And also copper and base metals had a good jump today.
Hey, thanks. Just so you know, my Wi-Fi is a bit off, so if I come in and out, it is what it is. But yeah, we've seen this for the last few weeks, actually. We've seen a turnaround in the base metals as the market seems to be thinking that China's back online and a lot of the states in the U.S. are coming back online. So maybe we bottomed out with respect to industrial production metals. And then the market has turned up. And so that's what's really hurting gold, is going back into the market and seeing the volatility indexes come down again. And so that's, for me, it's going to be a volatile ride. But I think the opportunities in this volatility is to pick up those stocks you like when it actually does come the other way.
No, that's a fair comment. I made a similar comment yesterday, and I hope I don't eat crow for that one, but just buy the dip. It seems the market is not buying the weakness anymore. We're flooding the market with liquidity, and inflation is going to hit us at one point, right? So,
hey, Guy, I was just going to add to that. It was interesting. Yeah. I was doing some marketing yesterday with a guy who is a former central banker in both the U.S. and Canada, interestingly, and he is not a gold investor at all. He just said, look, with the money printing and what's going on out there, he's just extremely concerned and looking for hard assets. So it's an interesting time where there's sort of that groups that are pulling in both directions here. Are we going back to normal, or is the economy restarting, or is this just sort of the beginning of sort of overprinting of money and sort of excess sort of levels of debt and zero interest rates? So it's going to be an interesting period with COVID overlaid on that, which makes it an extremely tough time to invest from my perspective, for sure.
No, exactly. And we've seen it earlier this week. There's been a small attack on gold, but it rebounded quite quickly. I think it was on Monday, where we dropped close to 1695 and quickly came back up. So the general market is not buying it anymore, the weakness, and they're looking for a hedge as they see now the liquidity is going to have an impact on their portfolio. And as you said, COVID is still a massive topic that has been, mitigated by other topics in the news this week, but it's still present. And in South America, it's rampant. Maybe in North America, not as much anymore. But we're not out of the woodworks economically in that regard either. So curious to see moving forward. And Florian, I'm curious to see, how are you positioning your fund in this environment right now?
Well, still sticking to our positions. We don't change a lot. We are long term. So nothing has changed fundamentally. Probably what we want to do is to go a little bit further down the market cap scale, because like May, we've seen a little bit of a shift where, all of a sudden some of the smaller cap names or the mid-tiers have started to outperform the senior pack. So, which is a good sign. I hope it's going to stay so buoyant. Today is obviously, a pushback, which probably has to be expected anyhow. But this is the sort of the market we're in. I mean, the worse the news, the better it is for the market, because everybody expects the Fed to go super aggressive and injecting more liquidity, and everybody's just front running the next move. So whenever you have a pullback in gold, it's small. We are talking about 1.5% today. On the other side, like Joe, you mentioned, copper is up 3%. So for me, the question is really, when do the base metals catch up to this whole to that whole money printing, which they terribly failed over the last 10 years. I mean, we've seen the top in 2011, and since then it has been a disaster. So it's going to be interesting to see when that market is going to turn. I don't know, but sooner or later it will. It's a question of when, not if.
Yeah. No, and you mentioned QE, just infinite money printing, and that's maybe a question for Christian as well. Isn't now the time to take on as much debt as possible and just grow the company like crazy, and maybe just buy anything you can find under the stars?
Oh boy, yeah. I mean, I guess when we look back, for us, it's been 3-4 years since we kind of started that, and Ross got involved, and we were definitely taking that view at that point when, certainly our space is gold. So when gold was below $1,200 and hanging around that level, is take on a little debt, take on a little bit of risk if you felt you had the strong long-term thinking and backing, and that kind of backing we get from Ross Beatty and Sovereign Wealth Fund of Abu Dhabi, et cetera. So we were able to take those risks, and we would have never guessed that we'd be at 1,700 gold so quickly. So in a sense, it's worked out well. A bit of luck there for sure. I'm a little more cautious right now with just taking on that kind of risk at this current price, because I think we're maybe in for a little choppy period here, because of the uncertainty in the market. So I'm not quite as aggressive in that sense. And for us, we've been buying over the last 3-4 years, and I'd say we're more cautious at the moment, but still opportunistic.
No, and you made publicly, you made that statement that you're sort of done with M&A, and I'm going to come back to that because I want to talk about more the current environment and how it has changed since January, pretty much, because the market was dead until December 2019. So, and let's make a full circle back around, and that's back to Joe now. The market has changed since January, and like you're covering the junior exploration space, the market, a segment that's ultra high risk and high reward. How has your subscriber base changed? Like, what are you seeing in investor behavior as well there?
I guess, we're picking up subscribers actually from Europe and places like that. We've always had a connection with Europeans, but a lot of them were Swiss, precious metals focused, but we're getting them from everywhere, it seems like, in Europe. But in terms of Canada and some places like that, the weak local currency has made the subscription a little bit more expensive for some. So it's a bit of a gain and a loss sort of thing. But my subscription base ranges from your retail person to company CEOs to VP explorations of major companies, institutional equity, and high net worth. So it's quite a broad spectrum of subscribers.
Okay, but like investor behavior itself, like, because you run a really interesting member forum as well that's quite active. Have you seen there a shift maybe in activity as well?
Yeah, there's a lot more questions about, private placements, because there's a lot of private placements coming, and people ask, oh, is this a company I should, what should I watch out for? That sort of thing. Because as we mentioned before, there are a lot more private placements trying to take advantage of the current market, a lot more broker deals, which we hadn't seen in a long time, a lot more bot deals and things like that. So that definitely makes the forum a lot. And also, we get a lot of questions about IR, like how much people are spending on IR. Is this a scam? That sort of stuff. Those sort of questions I get for companies I don't own, as well. Because we also seeing is a lot of these highly levered plays that have been out of news flow for about 5 years reemerging. And we're seeing those kind of plays that don't work at 1250, 1300 coming up and getting a lot more, notice.
Okay. To follow up on that part, do you think investors have learned their lessons over the last few years, or are just going to make the same mistakes again?
Nope.
No lessons learned. Okay.
But there's a little new generation of people that want to dip into it. As they say, a sucker is born every minute. It seems almost like every second. But the problem is that the companies and the people take advantage of that. And then once they're burnt, the problem is they might never come back to the sector. And so that's my concern more than anything.
No, that's a really good point. And Florian, like you're European based, you're Switzerland based. So Joe said there's more activity coming out of Europe right now as well in terms of subscriber activity. Are you seeing more inflows now into your fund as well? And obviously your performance has been tremendous over the last 3 years.
Yeah, basically we see inflows every time there is a dip in the market. The best inflows we had actually in March when the market really was in a mini panic. And this is always like investors are not losing confidence. They just look for more, okay, I see the cycle, I see where we are in, but what is the right time? Because like the last 3-4 years, when you look back to 2016 when we topped, virtually until 2019 it was a flat market. You didn't make money, and when you came out at the top in 16 around June, July, actually you were down 20-30%. So I think the top one is really to get the timing right. And I think investors learned from the past. It's volatile, it's cyclical, but it's in an uptrend. So the down days are, where we see most inflows, and on the upside, people tend to take some profits. But I think that's the right way to do, because we would probably do it ourselves. And myself in the fund, I try to do that as well. So, yeah.
Yeah, no, I had David Finch on, and he's from Ixios Asset Management out of Paris, and he says like we're actually having outflows because the market was doing so well, right? So that sort of perfectly concurs with what you've been saying. And Christian, like running a 3 billion mining company is a bit different than running a junior exploration company, obviously, and the phone calls you get are way different as well. But like, how's the what would you call it, the caller network, like how has that changed over the last 6 months? As I said before, like the market has been terrible till December. What kind of calls are you getting?
Yeah, well, I mean, for us, partly because of circumstances as well as the market, we've seen a real big change. And since we announced the merger with Leagold, we've become a much more liquid, visible company to, I call it, larger funds, being generalists and the precious metal funds. And so we've seen the more traditional gold funds start to look at a company like ours. And we've also seen a bunch of the larger generalists who want a very liquid, easy, accessible stock that they can start to get exposure to gold. And they tended to start at the Barricks and the Franco-Nevadas and the larger cap companies. But as I think Florian was saying earlier, they're starting to look down the market a little more. And we're probably at that next tier down that is now bringing them to the table. And I think we're seeing a lot more of that. And we've seen 40 new institutions come into our stock in the last 4 or 5 months. So we've seen a real evolution of that.
No, that's tremendous, and I think that's a good sign as well. And we'll see how that continues over the next couple of months. Because I've been saying for a long time as well, like the S&P can't deliver 20-25% every year, right? So you need to come up with a different strategy going forward to make that return, to generate those returns, right? Joe, and you hinted at a comment earlier, and your colleague or advisor Brent Cook replied to a tweet that I actually put out. That we're rapidly approaching a point where there's more money than legit targets out there to deploy into the market, right? How are you, like, you're a geologist, so for you it's a little easier to answer that question, but like still, like, how do you weed through the riffraff? How do you weed through maybe new deals as well?
Deals, I'm noticing a lot of this seed capital stuff getting in and looking at share structure. And when somebody says they own 10% of the company, did they pay $5 for it? That sort of thing. So the whole idea with any of these private placements or any investment is trying to get to know as quickly as possible. And that's the same thing you do as a geologist when you're looking at a new asset. You want to know whether you're going to waste a lot of time on it. You don't want to. And so you've got some barriers that you want to get through, whether it's share structure, management, the actual asset, the location, something like that that says, well, that's not going to get bought out. So my whole thinking is right now is that we see a lot more leverage driving share prices, and then you don't need to get bought out to get a double or a triple. But given the volatile markets that I think are still going to happen, I still go for quality, and I'm still looking for assets that potentially would get bought out. And so that gives me an underlying sort of evaluation for the company, as opposed to getting one that, works at $2,000 gold and just rips for a while and then needs to raise money, and then the gold price is $1,500 and they can't raise a cent. So that makes it easier for me. In terms of finding that, because I can get to know quicker if I've got that sort of mentality.
No, it's interesting because the rising tide lifts all boats, right? And being active on Twitter, for me, for example, you see so many people post about their wins, and the deals that go up, you just sometimes scratch your head. Is like, really? Like, how? And as a stock picker, you're almost frustrated because maybe the stock that you've picked is maybe not doing as well as one of the let's call them the crappy companies, right?
Look, Guyana Goldfields up 600% over about, I think, 2 months or something like that. 3 bids for that asset. That wouldn't be an asset that I would have thought had a multiple bid. So there you go.
Actually, it's like, that's a good point, and I've been scratching my head. I'm not too familiar with the asset they have, Guyana Goldfields, but since you seem to know, do you want to elaborate for that on that asset for a second, and why do you think like $1.80 bid for the company by an anonymous bidder is maybe a bit rich?
Yeah, but we got to understand that it's come down quite a bit, from its previous valuation when they got the mine going. The issue was that it was a big open pit, high strip, low grade deposit, and they had an underground component. The banks did not want the underground component. They only wanted the open pit, so they made the open pit bigger. The idea now, given the valuation and what you're paying for it, maybe the underground makes more sense, and maybe you can get some high grade out of the underground, given that all the infrastructure is there and the mine's built and everything like that, and it's permitted. And I think that's what people are maybe looking at. I don't know if that's correct. I've been to site, but I'm not sure if the new information is there that suggests that there's high grade components of the underground that actually can be mined. But still, you're running a process facility that's big enough for an open pit with the potential of running a much smaller underground. So, but again, that's not an asset I would have thought would have got multiple bids, because we've seen a few assets that have been taken out just because they're so cheap and people think they can run them better. But to have 3 different companies make a bid on that one was a bit strange for me.
Okay. No, thanks. And we're going to wrap that up. I was just curious, since you got some expertise on that, and I had a lot of question marks about it as well. So
I think it goes back to, Guy, I was going to say, it goes back to sort of, there is a lack of assets out there too, of as you said, permitted or in operation or de-risked to a certain level, although I'm not sure it's fully de-risked at this stage. But for us, as a group that's grown through acquisitions, there aren't a lot of opportunities out there, and a number of deals have happened over the last couple of years, and, consolidation has been a key word. And there's been a lot of, I believe, of good quality sort of exploration assets coming through that cycle at the moment who had the money. It's just starting now, but there's a gap there, and it needs to be funded so that people can bring some good assets along this curve. And so maybe it's a scarcity of assets too.
No, that's a really good point, because when I was still writing my newsletter back in 2015, 2016, it was easy to pinpoint the targets, like who's going to get bought out. Right? Because there's like 10 companies at the top of the value chain, and you could just say, oh, this one is next. Like one of them I remember correctly because it was Avenel Gold. I think you even bought it. I'm trying to think. Endeavor.
Did get bought by Endeavor, yeah.
Right? It might have even been you. It's like, but that was an easy one to
just
spot.
After me, but yep.
Right? Yep. So like, it was at the top of the list. It was easy to pinpoint. It was fully done, ready for takeout. There are not that many assets right now that people are willing to take out and buy, right? Florian, like you, I envy your position sometimes, because you're a fund manager. You get bombarded with new deal requests. Sometimes I'm just like, oh, he's getting bombarded with new deal requests, right? How is it looking for you right now? Are you being bombarded right now? Is it really like that? Like how I envision it?
Yeah, it's relatively active. I think there's a lot of broker deals being shopped around these days. I think it's an opportunistic market. I mean, the point is really money is lying around. You grab it when you can. I think that is the mentality, which can be quite dangerous, because when we look back like 12 months ago, no junior probably could tap the equity market without offering a 20% discount and half a warrant at 10% higher than the spot price. and now all those companies get money. So the question is really, okay, has your business changed so fundamentally to the positive that you are really able to get that cash and deploy it in the right way? And I think this is the real struggle for us. Who really has a business plan that can be executed and a strategy to create value. I think this is really where the group of companies is really shrinking to, as you said, Christian, to a very small universe of properties or companies. But it's a buoyant market. Things are getting pricier, and what we see also more in the development space is, how can you justify your valuation, whether you are just at a PA level or you're moving to pre-fees, but what is the real uptick from an investor from us? And so usually we try to stay back because we just don't see the catalysts which could, double your investment over the next 10 years. Let's say if you're already trading at 600 million market cap. So, but these are the deals that are getting done. I don't know who is investing in those things, probably more the generalists or the bigger funds, because those companies have the liquidity. And let's face it, it's passive investments everywhere. So fundamentals probably don't matter as much as they did in the last cycle. So it's all about market cap liquidity. And I think this is where you see these companies emerging into. But I think for us as an investor, we should ask the right questions. And so we usually bypass those deals now.
Okay, no, those are really good points. And sorry, Christian. Yeah,
Kai, I was just going to ask a question, probably on all three of you guys. I'm not a geologist, so I don't look at as many of these smaller companies, and obviously right now we're not looking at the earlier stage companies, but I do invest in some, I have to admit, and it's harder at times to differentiate in this kind of market. What are the quality ones? And something that I definitely consider important, and I'm curious on your guys' views, is do the management, the board, the key investors invest their own money? And when I say that, a lot of people like to take options and various things that are free, but they're considered equity linked in a sense. But I think putting your own money in and showing you've put an amount that actually is painful when the stock price goes down, or it's very successful if it goes up, is really important to me. I do that on a personal level, but I also think when I invest in something now, I do that more and more and look to who's actually putting their own money in, because it's easy to promote a stock and get out sometimes, but if you put your own money in and your own personal reputation almost is on the line, I think it's a big difference. Do you guys look at that? I mean, is that something that's important?
Joe, do you want to take that one?
I definitely look at insider trading and that comment on seed capital. That's another thing. And so when they tell me that they own 10%, I want to find out what the cost of that was.
Yeah.
And like you said, I mean, have they actually mortgaged their house to do this? And there's a few, like with the grassroots guys, I see a few younger guys coming up who are trying to do the right thing, and those ones I will back. It's grassroots, it's a concept and stuff like that, so it's very high risk. So you're even more weary of the management team and what they're doing. And if you can see that sort of desire, the passion, of that big win, their first big win. Those are the kind of guys I really want to back, as opposed to the tired, let's drill that hole again sort of thing, and let's change the name of the project, and nobody will figure that out. And then, let's do this again. That sort of thing. Or the lifestyle company that's, they say, oh yeah, we've been 20 years here, and goes, well, 20 years doing what? That sort of thing, I'm just not interested in. I mean, it is a long-term play, and the retail has a problem understanding that exploration takes a long time, and they don't understand that, all the drill holes aren't going to be 50 meters at 20 grams, So you got to tell them that I believe in this company, I believe in these people, and eventually if they win, I'll trust them, because those are the kind of guys I want to back. I mean, my portfolio right now is just about as much as making money as not getting embarrassed.
Not getting embarrassed, I think, is a really important point. That's No. And maybe I can answer that one as well, because you all know, is like we run a public communications company. not getting embarrassed is actually the number one aspect, and that can be any kind of range, right? So because you're only as good as your last deal that you worked on. And Joe, you mentioned something before as well, and something we closely look at is share structure, like of a deal. Like as you said, like how are the seed investors positioned? And it gets really complicated because you got to talk to the newsletter writers, you got to talk to other investors, and like I have a newsletter writer and another investor from my network here on the panel. Like if I bring you a deal where everybody has like 0.005 cent shares, like what's the point of Florian or Joe even looking at it? Like it's not skewed in our favor, and it doesn't need to be skewed in our favor, but it needs to be an equal playing field. Right. So those are the deals we look at, and I personally invest in as well because I want it to be fair and I don't want to be the last one out of the door. And there's the famous saying, the German backholders, right? Because we always see when we market into Germany, like the Germans always used to hold the back because we're the last ones to receive any information. They're the last ones to get promoted to, right? Usually the promo campaign starts in North America. So the stock runs up to, I don't know, it runs up to 50 cents in North America, and then, let's go to Europe. And then they run it from 50 to $1. So that's still 100%, which is not bad. But the Germans are the ones that usually lose out because when the promo ends, they're the ones sitting at $1 and everybody else has been selling, right? So that's where I was going with this. And Florian, like maybe segue over to you for a second as well. Like I'm not even sure what your fund allows in terms of early seed rounds, right? You have 29 positions, I think?
Yeah, right. Exactly. We usually don't do seed rounds. It's too small based on liquidity. And, we do exploration things from, let's say, 20 million upwards. The question is always, okay, how is management tied into their company? What we don't want to see is zero cost shares. Usually what we want to see, you participate in each deal. You're not fully loaded with warrant. When I go to your circular, I see your salary, which must appear reasonable, and unfortunately there is still a lot of misconduct in this way. So I think these are just the sort of red flags we want to stay away. But it's really like, as you said, Christian, I mean, the alignment should be not just like, we own 20% of the stock. Okay, the question is at what price?
Yeah.
And then the stock is offered to you. Okay, what is your intention? And probably the intention is just, okay, we own too much, we want to sell a portion. We just don't tell it to you, but that's the thing, right? And you don't actually have a plan to execute on. So I think it becomes really, really tricky. So for us, it's really, what are you going to do with your money? And then this is where we want to probably join or not. So tell us what your plan is. And your upside should be our upside, and we don't want to buy your shares when you make 10 times your money. We're not interested in that, sorry. Well, I think that is the sort of area investors should really dive in those documentations and go through these old-style CDR filings. It's a lot of, boring work, but I think you just have to do it.
Yeah, it's interesting. That shareholders gold council, I think it's called, or whatever, that came together a couple of years ago, and it's been sort of asking for that sort of approach of reasonable pay, alignment with shareholders, investing your own money, all that kind of good governance type stuff. And you've seen it, I think, a little more active. I thought it would be more active than it has been, but you've seen Paulson and a few others be quite active in that space. And it's probably a positive thing for the sector if it filters through to a certain degree. And we actually had one of those founding funds buy our stock in a big block 4 weeks ago. So it was kind of nice to see that it transitioned to actual real buying, which on the back of what we think is doing the right thing, which is good. That's great. And by the way, Kai, just so you know, I'm Canadian. I grew up here, but I have a German passport. So now I'm getting worried about my, am I buying stocks at too high a price or what?
Well, it depends on where you get your emails from, right? What emails do you read, I guess, and who you follow. No. Joe, like you mentioned that, and Christian, I got another great question for you as well. Like, but Joe, you mentioned that aligning with shareholders or aligning and by putting money in, and you said like you love backing juniors or juniors, like new companies that start out new, young people. How are we supposed to align ourselves when we haven't made any money in the business?
In terms of the juniors, like 10 million or that sort of EV.
Yeah, you start out like, let's say you were an exploration geologist at a mid-tier company. You get out, you start your own company, and you're looking for support. Like, how do you measure alignment there?
Like as an investor,
Exactly. Like when you do your due diligence, like let's say the guy's 33 years old, he's worked at a mid-tier company for the last 8 years, gained some experience. Now he wants to do his own company or start up his own company. How does he align himself when he hasn't saved up $500,000 or $1 million to put into the new deal?
Yeah, and so this is interesting because guys that have worked for companies, they don't make a lot of money, and when they come into this sort of environment, people are saying, "Hey, how come you haven't spent $500,000 on your shares?" And so, well, he doesn't have $500,000, and so he does what he can. And so, and my thinking is like, in terms of your budget, what's your commitment? Oh, I haven't taken a salary. I'm just taking shares. I took a second mortgage on the house, and these guys are really hurting if this thing doesn't work. And importantly, they've got a vision. Like this is what we're looking at, and I understand this. And so the idea is, like any company, whether it's $20 million or less EV up to multi-billion dollars, I mean, what is your strategy? What are you trying to do? Are you funded to do it? What's your end game? What do you want to be when you grow up? And that's what I try to get from these guys. And those mature sort of mid-30s, not like what I was when I was in my mid-30s, mind you, they have that vision, and I can see it. I don't need the drill hole to prove that at this moment because it's a risky and the reward, but I need to see that they're actually going to make money by this share price going up.
Okay, no, fair enough. And Christian, it's actually great having you on the board as well, because that way I can pressure you a little bit and ask you about what Equinox is doing. Now let's talk about the company for a second, supporting those juniors, because in the end you benefit from whatever's coming up upstream. Right? In the end, let's say Equinox is going to survive, not going to get bought out. You want to grow. You need assets you can buy. Are you looking now, or are you dedicating some funds to invest into those, let's say, junior companies that are not at a state that are relevant for a takeout yet?
Yeah, I would say literally, Kai, we're just sort of turning the corner on the ability to maybe to even consider that at this stage. We've been sort of scrambling to build projects and basically deleverage our balance sheet and get the company to a more steady state where we can start thinking like that. And I think we're just sort of turning that corner in the last few weeks almost. We had another $150 million come in, and our balance sheet's very strong now. And we would look a little more in that direction, although we much prefer to own the asset. So at the moment, it's a big stretch for us to be a 10% shareholder in something. We're maybe not quite large enough yet and have enough capital to really be doing much of that. I think if we really like something, we'd consider it. But I think the big dilemma for us is if we like it that much and we want to own 10 or 20%, why don't we want to own the whole thing and actually add some expertise that we think we could add, or keep the upside in a sense internally to ourselves. So we maybe haven't turned that corner fully. I think financially we have, but maybe not mentally yet. But I agree. Earlier on, when we were talking about deals, there are less and less of them that are at that stage that we can acquire that are either in production, that are ready to be part of a bigger group, or getting close to being in production. They've been built and sold, a lot of them. I'm just going to use one example, but Continental Gold, I know it had its challenges for a while there, but I think they did a good job and got it basically into production and sold for a good price to a Chinese group. It's now off the market. That would have fit nicely in our portfolio in terms of maybe adding another long life, good grade, lower cost asset that rounded out our portfolio, but it's gone. And so we're seeing more and more of that happening now, and maybe we have to be a little more creative and come down the market, just like investors are doing.
No, I've seen.
I got a question.
Go ahead. Yes.
I got a question.
Yeah.
Just for Christian.
Yeah.
It's like when you look at your assets, and when people look at your company and geopolitically, your jurisdictionally, do you look at that when you acquire and say, oh my God, this is going to put me into this sort of category, and then I might lose some people? Do you think of that? Like, I'm going back to SSRM with Alistair, because that brought a big Turkish component. It didn't impact them negatively, but potentially there might have been some investors that were looking at that company like, hey, you're North American based now, your Argentina exposure is diminished, now you're a gold company, blah, blah, blah. But now you've gone to Turkey, and now when I look at the asset valuation, you're more a Turkey company, and do I want to be exposed to that? And so do you look at that?
Absolutely. It is a key criteria. And I would say when we were starting out, obviously Endeavour Mining was West Africa. Now this one's been now focused on the Americas. But when you had one asset or no assets to start, I think you're a little more agnostic in a sense, because you can start to build your strategy around a good asset or deal or a starting point. When we started to add a couple of assets in the Americas, it became very clear to us, number one, our shareholders that started to invest and follow and keep investing very much like that strategy. There is a scarcity, I call it, of Americas-based businesses. So for us, it is an important, I'll call it selling point, but also management point now. It's easier to manage things that are in, call it one region roughly. So it's become more and more of a focus to us because there's some great assets. I know of a good asset in the PNG. I know good assets in West Africa. I think it'd be a lot more of a stretch for us to sell it to ourselves, but also to our shareholder base. And I think we would lose some. I mean, I know some that have said they would be unhappy if we went there. So it has to be an important factor now as we grow. But I think at the early days, if you're a bit more agnostic, it's okay. And maybe when you get to a larger scale, I'm going to call it a B2 or a Barrick, they obviously have a much more wide range of assets across a lot of countries. Maybe you can say it's more diversity. I think in the Americas for us, there's enough countries and diverse locations that we can be diverse, but still in a very focused region.
Florian, I've noticed
that's a key criteria.
Florian, I've noticed you're invested also in Africa. Like, what's your regional focus, or how do you select jurisdictions?
We feel comfortable in West Africa, North America, Australia, New Zealand. Where we don't want to get involved is the more risky perceived jurisdictions. And what is always good for us to have is if there is a local, if there is a big mining company history, if there has already been invested, into larger scale billion sort of style project. So that actually tells a smaller company, okay, you can go and do business there, but it's not a really new frontier market where you have to just cope with too many risk factors and things like that. So yeah, I mean, we try to stick where the money flows, and we try to stick to jurisdictions where you actually can do business. And when I look back, like over the last 5 years, the sort of activity in West Africa has been tremendous. I mean, the number of new mines coming online in West Africa is probably outpacing everything else on that planet. So I think it's a little bit of a geographic disconnect. If you're in North America, West Africa is very far away. It's in another time zone. It's not easy to manage a company out of Toronto which has assets in Africa.
Florian, might have lost you there.
Close from the industry because we think.
Now it seems like maybe the internet here in North Vancouver is a bit spotty too. So
yeah, we try to invest.
Kai, I was just going to say, in terms of political risk, it's interesting because I agree with Florian to a certain degree. Building assets in West Africa, we had a good experience with that at Endeavour. Having a good experience in the Americas, but political risk comes in so many different forms and ways, and it's amazing how investing groups and regions have a view on political risk. Sometimes certain European groups prefer Africa because they're comfortable with it. Some North Americans prefer South America because they're comfortable with it. But I think they all bring a certain level of risk. It's a risky business. And, I even look at our portfolio, you'd kind of say Western US or even BC or something is low risk. But actually, there's a reasonable amount of permitting risk in those areas, or, dealing with First Nations and Indigenous groups, or, other things where I found in West Africa, sometimes they were more welcoming in terms of they want your investment, they want the jobs. The permitting process was more protracted, and you actually had a clear, shorter term process. So I think it comes in different shades across the world. And again, diversity as you grow, like for us, we're kind of sure now of having multiple jurisdictions where you can kind of balance them. A single asset company obviously can't, so they have to be very comfortable. And for me, I like to know the team is actually very comfortable in those areas and have done something in the past, so they've got the experience if it's a single asset.
No, and as you said, you've been in West Africa. Would you feel comfortable in going back there? And I want to learn a little bit more about your experience sort of turning Karma around in that regard as well, if you can spend a minute on that as well.
Yeah, I mean, I would absolutely go back to West Africa. I loved working there. I have very good relationships
Christian, by the way, sorry,
workforce
your microphone
people.
is rubbing on your sweater.
Oh, sorry.
Sorry about that. No worries. Okay, perfect.
Yeah, I mean, West Africa, I'm very comfortable with. I really enjoyed it and a good experience. Good government relationships when there was a good governments in place, and loyal workforce that was keen to learn and get these good jobs. And and I found it was a great place to build mines and operate. I would definitely go back. I think, though, going back to Joe's question, it'd be harder to do in our current structure because of our America's focus on scale now in the Americas. In terms of karma, interestingly, when I look back, I was at Endeavour Mining as a CFO when I jumped into that role. Probably sometimes jump in and leap into things without doing as much due diligence as you could have. If I had done more due diligence, maybe I wouldn't have. You know, it was a tough situation to turn that around. But I believed in actually Burkina Faso. I knew government members there, and I knew they were serious about having gold investment into the country. It was a very key sector for them. So I felt that there would be a reasonable compromise to turn that mine around and basically unlock the government relations and community relations situation. And I felt the asset was a decent quality. So I took a bit of a bet on my career in that sense. And, you know, fortunately it worked out, and Burkina has just continued to evolve. It's unfortunate with the security threats, but otherwise they've been very positive for investments.
Oh, fantastic. So we're sort of coming up slowly on our time limit, and I want to circle back around. We've been talking about M&A, and Christian, I asked you about majors or mid-tiers investing more into the junior end of the market. I think Agnico has been really active there. And Joe and Florian is like, do you see that more happening now as well? That companies are going to mimic what Agnico is doing? Like, I think they took 19.9 in Rupert for a decent amount of money. I think they invested 13 million. I'm not sure if it was US or Canadian into Rupert for a stake, just to see the company advance and go further. Do we see that more happening? And at $1,700 gold, I hope we come back to that level today. They should generate more cash flow or free cash flow to be able to do that.
Me first?
Yeah, go ahead. Sorry. Yeah, we'll go clockwise.
Okay.
Sure.
I can't see the clock, but yeah. So I mean, this idea of investing in the juniors, I mean, this has been happening, I mean, for decades. You know, Teck started it. I mean, I was heavily involved in the Newmont exploration portfolio when I worked for them. And if you look at that, one way a company gets a stake in a junior is because they sell them the asset. And so they're actually a seller, even though they own 10 or 15% of it, or even 19.9, it's because they sold them the asset. What you want to see, if you're an outside investor, that the majors investment is actually proactive, that they're actually put their money in, just like a normal investor, and that they're interested in the underlying projects. And so we're seeing a lot more strategic alliances. I mean, in the gold sector, specifically, as they've cut back their G&A and cut back their exploration. But in the meantime, some companies have gone out and staked big land packages, something that those gold companies aren't doing as much, and they want leverage to it. And for them, it's not a big deal, spending a couple of million to find out if it works within 18 months and then bailing later. And unfortunately for the company, it gives them a big premium. But when the major leaves, it sort of takes all the air out of the balloon, unfortunately, because then it seems like the confirmation of their concept and what they're doing has been given, but when it's been taken away, it's almost a bigger negative.
I think we've seen a couple examples, and I don't mind naming them. Like, one of the negative examples, unfortunately, was Aston Bay. I think a company you followed it as well, when BHP, for example, was a partner. Positive example, or at least right now until they pull out, is maybe Barrick and Japan Gold, or Newmont and Irving Resources. Is that how I would categorize it?
Yeah, I would say for me, even though I like the people and I like the asset, whatever, is ATAC. Because ATAC was remote, it was selling this big, and rightfully so, this big, Carlin district scale sort of thing in the Yukon, infrastructurally challenged. And Agnico's investment was a little bit more passive. They weren't giving them a lot. But when Barrick came in and they actually deal with these kind of deposits in Nevada, that was a big confirmation for their concept. But when they pulled out, I'm not sure it recovered from that.
Okay. Florian as well, like, do you see that happening as well? Like, how do you play this? Like, this is really tough. Like, do you see that more happening? The M&A getting more active? Are you positioning maybe yourself in juniors that are more appealing, or is like to a major? What's your buyout? Like, what's your exit? Florian?
Yeah, can you hear me?
Yeah, now I can hear you.
Okay, good here. No, I just have a little bit of a weak signal. Yeah, I think the M&A space is like, multiple fold. On the one side, we have, companies like you mentioned, before, so Alaska transaction is, you merge to get your market cap up and you become more attractive for shareholders, is like a function of the market to some degree. And the other thing is, investments from the majors into more the I guess this is more, you get in early, but it's not moving anything on a fast way. I think this is what we have learned lately is, the mid, especially before they make a decision, it really takes time. This is like discussions which are going on for a year or 18 months, and eventually they write a check for 2 million. So this is really, not a big deal of money, but they're obviously doing their homework, which is good. I think the more interesting thing would be to see, what about new jurisdictions, like, for example, the deal between Rio Tinto and Calibre in Nicaragua, which is like a $45 million JV into a new territory. What's that to trigger in sort of future M&A transactions? So when you're going outside of your current box and you try to access new jurisdictions by buying into a junior, I think this is the other sort of development which we could see, and it's going to be interesting, of course.
Cool. So let's sort of wrap this up before we lose Florian on the Wi-Fi here in Switzerland as well, and they cut the cords to Europe. Christian, I'm going to start with you. Like, give us a bit of an outlook for the next 3 to 6 months, and you can make it also Equinox specific. That's absolutely fine. Like, and I want to ask you, like, sort of besides gold, of course, you're a gold company. What other commodity do you see maybe outperforming the next 6 months or to year end? And I'm going to ask a similar question to Joe and Florian to sum this up as well. So,
yeah. I think there's a new normal in a certain way here, and everyone's trying to learn, not just our sector, how to adapt and live with it. And so I think there's a level of, it's not necessarily going to be volatility, but uncertainty that people have to learn to live with. And even for us on an operational basis, how do you live with sort of slightly different travel perspectives, office environments, working remotely, dealing with COVID risks and that on an ongoing basis. And it will adapt, and I think a lot of companies will have to think around the new world and the new way of operating. So I think we're all going through that at the moment, which adds to the uncertainty for investing from my perspective. I'm a precious metals investor. Even privately, I do have a lot of my own investments into precious metals. So obviously I'm bullish on both silver and gold in a sense, naturally. But I also like copper long term. I mean, I like the whole sort of clean energy, renewables aspect to it. I think copper is a great metal. I think it's going to maybe be undersupplied eventually as well, and then a little bit off the market or off the wall a little bit. I like uranium from a completely counterintuitive. I'm no expert in uranium at all, but I just kind of like the uranium space, and it's so out of favor over the last number of years that I'm kind of excited about that one as well.
Cool. Joe, you're next up next to me. You're on my right. So how do you see the next 3 to 6 months shaping up? And give us your favorite commodity outperforming year till the end of the year.
Okay, I'm not sure if you got my video. Do you got my video?
No, you're not moving much.
Okay, just imagine me talking, I guess.
At least your eyes are open and
yeah,
your mouth is closed, so sorry.
Yeah, so as long as you can hear me, I'm looking at these issues on supply chain and people wanting to localize product, and so that's something like, as Christian was talking about, potentially something that might make uranium a little bit more favorable, but that might be a couple of years. But that's definitely something that's interesting. I still like copper, and I'm still putting myself investing in the plays that actually fill a window around 2025. So I'm still interested in that, and the COVID crisis has forced a lot of companies to cut exploration and cut development and cut sustaining capital. So I think in the next 3 to 5 years that might have a bigger kick in terms of the balance. Yeah, and I think the greenhouse gas emission stuff, whether it's nickel, copper, or that sort of thing, I'm still into. But again, precious metals is at least 60 to 70% of our portfolio right now.
Cool, fair enough. Florian, how are you going into the remainder of the year? Like, are you maybe shifting something in your fund, or do you have another favorite metal that you might want to add to it?
Yeah, well, basically sticking to gold. I think this is what works best for the time being, because it's like, for me, gold is a little bit of a non-brainer. We have those deflationary forces, and as long as this persists and has overhand, I think people, the base metal camp, I understand all the supply dynamics, but I think for the time being, I would still be overweight in gold, probably a little bit of silver. But the cycle will change when we get more, I think the market has to recognize that there is somewhere some sort of an inflation pressure. And if that attitude changes, then I think you just can be in the base metal camp again, and probably you want to be overweight. Right now, I stick to gold. Yeah.
Cool. Great. I really want to thank my panelists. This was a fantastic panel. Gentlemen, really appreciate your time. Christian, Joe, Florian, like today the market is really active, so Christian, I appreciate you taking an hour out of your busy day talking to us. Joe, Florian, I wish you a wonderful weekend. I can't wait. 5 more hours for me and then I'm out of here. So I'm looking forward. Gentlemen, enjoy your beers and drinks this weekend. I really appreciate it. So thanks for tuning in. Make sure to subscribe to our YouTube channel. Follow us here on Twitter, obviously. Turn on the alert buttons. That way you get notified when we go live with another update here as well. Thanks, everybody. Talk soon.